All right, so are you ready to dive into the world of luxury investing?
Let's do it.
Okay, cool, because today we're looking at Hermès. You know, those like super pricey handbags and
Yeah.
accessories. We've got this really interesting video analysis we're going to break down, and it even has insights from the legendary investor Terry Smith.
Yeah, he's a fascinating guy.
So whether you're thinking about like adding some luxury stocks to your own portfolio, or you just want to know how these brands stay so strong even when the economy isn't doing so great,
Right.
this deep dive is for you.
You know what's really interesting to me is that Hermes, they're not just a luxury company. They play by different rules.
Okay, how so?
Well, we're talking about a brand that's so powerful, it almost like defies traditional economics.
That's a bold statement.
It is, but I think it's something anyone interested in investing, no matter what sector, can learn from.
Okay, I'm intrigued. Let's get into it. So the video calls Hermes products Veblen goods,
Yeah.
which means higher prices actually increase demand. I mean, does that even make sense?
I know it sounds crazy, right?
Mhm.
Most products, they become less desirable as the price goes up.
Yeah, of course.
But Hermes, they've created this image, this aura of exclusivity. It's
Okay.
like the idea that owning one of their products makes you part of this special group.
It's not just a handbag, it's a status symbol.
And exactly. And that story becomes even more compelling when the price is, astronomical.
So it's almost like a psychological thing. The higher the price, the more you want it.
Right. It's like a badge of honor.
But does that actually play out in the real world?
It does. The source material points out that while the overall luxury market was kind of struggling in the third quarter of 2023, Hermes actually saw 11% revenue growth.
Wow, that's huge, especially when a lot of companies were feeling the, economic pinch.
It is.
So even when things are tough, people are still, lining up to buy those Birkin bags.
Pretty much. It's a coveted item.
It must be more than just a status symbol, though,
Oh,
right?
yeah, there's more to it.
What else is driving that resilience?
Well, you got to look at their customer base. Hermes caters to a very wealthy clientele,
Okay.
and that wealth provides a buffer against economic downturns.
So these are people who, their spending habits aren't as affected by things like inflation or a recession.
Exactly.
So understanding a company's target market is crucial when assessing its long-term potential.
It really is.
It's like having a built-in safety net.
Yeah, you can say that.
Yeah.
But there's more to their success than just wealthy shoppers and high prices.
Right. What about their actual business model? What sets them apart from other luxury brands?
Well, unlike a lot of luxury groups that are spread across, tons of brands, Hermes operates as a single focused entity.
Okay.
They have a ton of control over their image, their production, and their whole customer experience.
So they're not trying to be everything to everyone.
Nope. And that focused approach really contributes to their strength.
Okay, so we've got this incredibly strong brand, a loyal and wealthy customer base, and a really tightly controlled business model.
Mm-hmm.
Now, how does all of this tie into Terry Smith? Who is this guy, and why should we care what he thinks?
Well, Terry Smith is often called the British Buffett.
Oh, wow.
And the video really highlights his focus on something called return on capital employed, or ROCE.
Hold on, let's break that down for a second. I know some of our listeners might not be, finance experts.
You're no problem.
Yeah.
Let's say you decide to design a limited edition silk scarf like the ones Hermes is famous for.
Okay, I'm with you.
You invest $10,000 in materials production and marketing. Now, if you sell enough scarves to make a $2,000 profit, your ROCE would be 20%.
Okay.
It's basically a measure of how well a company uses its capital to make a profit.
So the higher the ROCE, the better.
Exactly. It shows they're efficient.
Got it. So high ROCE equals a well-run, profitable company. What else does this Terry Smith guy look for?
He really values predictability. He prefers those businesses with steady, predictable revenue growth.
Okay.
He's not interested in companies that are susceptible to big swings in demand or profitability.
You want stability.
Yeah. And he's known for avoiding what are called cyclical industries like mining and oil.
Because their performance is too tied to unpredictable factors, like global commodity prices.
Exactly. Or geopolitical events.
Yeah.
Things you can't really control.
Right. So he's all about finding those companies that are built to last no matter what's happening in the economy.
Yeah, that's a good way to put it.
That makes a lot of sense. But how does he actually decide how much a company is worth?
Does he just go with his gut?
Right? Does he have like a magic formula?
Not exactly. But he does have a specific valuation method that he uses.
Okay.
It combines a company's cash flow yield with its projected growth rate.
Okay, I'm following you. So we've got Hermes, this luxury powerhouse, And Terry Smith, the investing guru who loves predictable, high ROCE businesses. How do these two connect? Is Terry Smith a fan of Hermes?
That's where it gets really interesting. The video highlights that Smith has recently become interested in Hermes. He sees them as the prime example of the kind of quality business he looks for.
Okay.
He acknowledges that their valuation is high, but their track record and brand strength make them a really potentially compelling investment.
So it's not just about finding a cheap stock, it's about finding a great company, even if you have to pay a bit more upfront.
Exactly. And it's important to remember that overpaying for a high-quality company can still lead to disappointing returns. It's about finding that sweet spot between quality and valuation.
It's all about balance.
It is, and it's not always easy to find.
Now, this video also goes into a topic that's been getting a lot of buzz lately, artificial intelligence. And it seems like Terry Smith is, well, maybe not as excited about the AI boom as some other people are.
Right.
Why is that?
He's actually comparing it to the dot-com bubble of the early 2000s.
Oh, wow.
He's arguing that while there's a lot of hype around AI tools like NVIDIA's graphics processing units, which are essential for AI development,
Yeah.
the question remains, where's the profit?
So just like back in the dot-com days, we have companies selling the tools for this gold rush, but the gold rush hasn't quite happened yet.
Right. And he's saying, hold on, let's see some actual gold before we go all in.
That makes sense.
Yeah.
So speaking of companies that are producing something tangible, the video mentions a company called Fortinet that Smith has recently invested in. What's the story there? Why is he interested in this particular company?
Fortinet's a cybersecurity firm, and Smith sees a lot of potential in this sector, even though it's faced some, short-term setbacks. He's drawn to their consistent revenue growth and their focus on, addressing a real and growing need protecting businesses from cyber attacks.
Right. Cybersecurity is a huge issue these days.
It is.
Okay, so maybe not as glamorous as high-fashion handbags, but definitely essential in today's digital world. What does this tell us about his investment strategy?
It shows that he's willing to invest in companies that might not be the most popular or well-known.
The underdogs.
Yeah, as long as they have strong fundamentals and a clear path to growth, he's not afraid to go against the grain, especially when he sees value that others might be missing.
So it's not about chasing the trends. It's about looking for the substance behind the headlines.
Exactly. It's about thinking like an owner, not just a speculator.
I like that. So what kind of businesses do you want to be a part of? What kind of companies are building something real and lasting? Those are the questions we should all be asking ourselves.
Absolutely.
All right, so we've covered Hermès Terry Smith's investment philosophy and, a healthy dose of skepticism towards the AI hype train. What else does this video offer in terms of smart investing strategies that our listeners can use?
One of the most important takeaways, I think, is Smith's emphasis on discipline.
Okay, how so?
He believes that having a clear investment strategy and sticking to it is absolutely crucial for long-term success.
So it's not about trying to time the market or jumping on every hot new trend.
No, it's about having a plan and staying focused.
I see. And what else?
Patience. As Keith Smith is a big believer in waiting for the right opportunities, even if that means sitting on the sidelines for a bit.
So don't feel pressured to jump in right away.
Exactly. He reminds us that great companies, they don't always come at bargain prices. Sometimes you have to be willing to pay a fair price for quality.
That's tough, though, in a world where we're constantly told to get in early and don't miss out.
I know it is. But think about it. If you're really investing for the long haul, a few months or even a year of waiting isn't going to make or break your returns.
Right.
What will make or break your returns is buying into companies that ultimately can't deliver.
So patience and discipline combined with a focus on quality and, a healthy dose of skepticism.
Yeah.
Sounds like a pretty solid recipe for investing success. Is there anything else we should keep in mind?
There's one more really important piece of advice from the video. Smith strongly cautions against investing in companies with questionable ethics or weak fundamentals.
Okay, so no matter how tempting the returns might look, he believes the risk is too high.
Exactly. He believes that ultimately the risk of loss outweighs the potential reward.
So it's not just about making money. It's about making money the right way by investing in companies that are doing things the right way.
Exactly. It's about aligning your investments with your values. And in the long run, that alignment is not only ethically sound, but it also tends to lead to more sustainable and fulfilling returns.
All right, so we've covered a lot of ground here. Hermès, Terry Smith, AI, the importance of discipline, and even a bit of ethics. Before we move on to part 2 of this deep dive, do you want to highlight anything else for our listeners?
Yes, I think it's worth repeating that while Hermès might seem like a very specific case study, a luxury brand that caters to the ultra-wealthy,
Right.
the principles we've talked about today, they actually apply much more broadly.
That's a great point. So what does this all mean for our listeners who might not be shopping for Birkin bags anytime soon? What are the key takeaways they can apply to their own investment journey?
Well, first of all, it's about understanding the power of brands. Think about the companies you admire, the products you trust. What makes them stand out? What gives them that lasting appeal?
Right. So we're not just talking about luxury goods here. It could be any company that has built a strong reputation and a loyal following. What else?
Exactly. And second, remember the importance of ROCE. It's a simple but powerful metric that can help you evaluate a company's efficiency and profitability.
Okay.
And third, embrace Terry Smith's emphasis on predictability and avoiding cyclical industries. Look for businesses with steady, predictable growth rather than those that are prone to those wild swings in fortune.
And finally, remember the power of patience and discipline. Don't get caught up in the hype of the moment. Do your research, choose your investments wisely, and stick to your plan.
Absolutely. And above all, never stop learning. The market is always changing, and the best investors are the ones who are always seeking new knowledge and refining their approach.
I love that. Investing is a journey of discovery and growth, ready to keep exploring. We'll be back in just a moment with part 2 of our deep dive.
Sounds good. As we look even closer, at this analysis, it really hits me how Hermès just embodies this idea of resilience.
In what way?
Like their whole business model, who they're targeting their brand, it all just screams stability. A company that can handle whatever the economy throws at it better than most.
So while other luxury brands might be hurting when things get tough,
Yeah,
Hermès is more likely to sail through.
exactly. And that kind of stability that's really attractive to an investor. It's not always about chasing the highest returns,
It's about consistency.
Yeah, finding those investments that can deliver solid growth over time, even when things get a bit rocky.
Which goes back to, Terry Smith and what we were talking about with his approach. He wants those companies built to last.
Exactly. Remember all that stuff about ROCE and predictable revenue and avoiding those cyclical industries?
Yeah.
Hermès really checks all those boxes. They're not completely immune to economic cycles, of course,
Right.
but their business model really does help cushion those blows.
It's wild how a brand known for, expensive handbags can teach us so much about investing.
Right.
It's a good reminder that even if you're not buying Hermès stock, there's still valuable lessons to learn.
Absolutely. It's all about understanding the core principles, the things that make a company truly successful. You can use those principles to find other companies with similar strengths, even in totally different fields.
Yeah.
It's a way of thinking, not a set of rules.
Before we wrap up, I want to circle back to the AI discussion for a minute.
Okay.
There are so many different opinions about, is AI really revolutionary or is it just hype?
It's definitely the hot topic right now, and people have strong feelings about it.
They do.
Yeah.
So as investors, how should we approach this?
It's about being critical. Don't just get caught up in the excitement. Ask the tough questions.
Like, where's the money?
Exactly. How are these companies making money? Are they solving real problems or just riding a wave?
It's so easy to get swept up in it all, especially when you see, companies like Nvidia doing so well.
Yeah.
But like Terry Smith warned us that growth might not last without real results.
It's true. And think about the dot-com bubble. All those companies that promised the world.
And then,
And then nothing. They couldn't deliver. Investors who just bought into the hype without doing their research, they got burned.
so for our listeners who are thinking about investing in AI, what's the main takeaway?
Don't just invest in anything with an AI label on it.
Well,
Look for companies that are actually solving problems. Making real money and showing a clear path to profitability.
because even in a field like AI, there will be winners and losers.
Right.
It's our job as investors to do our research and find the companies that are most likely to succeed in the long run.
And that brings us to another point Terry Smith made: patience. Don't feel like you have to jump into anything no matter how exciting it seems.
Right.
Take your time, do your homework, and wait for the right opportunity. Investing is about strategy, not speed.
Sometimes the best move is not making a move.
I agree. Avoiding those impulsive decisions and sticking to your plan, that's key.
We're not trying to be perfect. We're trying to build a strong portfolio with companies that can deliver steady growth over time.
That's the goal.
And that long-term perspective is so important, especially these days when everything moves so fast. It's easy to get distracted by all the ups and downs.
It's true, but successful investors, they can block out the noise and focus on the fundamental.
You're right. It's about knowing your goals and sticking to your plan no matter what's happening in the market.
Exactly. Investing is a marathon, not a sprint. Remember that.
Okay, so we've talked about a lot. Hermès, Terry Smith's investing style, the AI landscape. As we move to the last part of our discussion, what are the key takeaways you want listeners to remember? We're back for the final part of our deep dive, and man, we've covered some serious ground.
Yeah, we have. From luxury handbags to AI, it's been quite a journey.
It has. We started with, Hermes and their unique appeal, then got into Terry Smith's whole investment philosophy, and even tackled the big question of AI. Is it the real deal or just hype?
It's amazing to me how the stuff we talked about, even though it started with, just one company and one investor, it's relevant to way more than just luxury goods.
Totally. I mean, we've discussed ROCE, brand power resilience against economic downturns. Those are things every investor needs to think about.
Exactly.
Yeah.
No matter what you're interested in, tech, healthcare, whatever,
Yeah.
it all ties back to those fundamental principles.
So you're saying that even if something seems really niche at first glance,
Yeah,
there are often these universal lessons hidden underneath.
exactly. It's like you said, a deep dive. Sometimes you got to dig deep to find the real treasure.
It reminds me of that quote, the more you learn, the more you realize how much you don't know.
Huh. That's so true.
Yeah,
But the learning process, that's what keeps it interesting.
it does. So speaking of learning, you said you had a thought-provoking question for our listeners.
I do. Something to think about as they continue on their investing journey.
Okay, I'm all ears. Hit me with it.
So we spent a lot of time talking about Hermès and Terry Smith's approach, right?
Yeah, quality, ROCE, predictability, ethical practices.
Mhm.
The whole 9 yards.
Right. So the question is, what other companies out there fit that same mold? Are there businesses maybe outside of luxury that share those same characteristics?
Wow, that's a great question. It's like sending our listeners on a scavenger hunt,
It kind of is.
challenging them to find those hidden gems, even if they're in completely different industries.
Exactly. It's all about using what we've learned, to think critically and really see the investing world with fresh eyes.
It's empowering them to make their own informed decisions.
Exactly. And what's great is there's no one right answer. It's up to each person to, do their own research and develop their own investment style.
That's what makes it so interesting. It's not about giving everyone a step-by-step guide. It's about giving them the tools to think for themselves.
That's the whole point of the deep dive.
Yeah.
We want to spark your curiosity and help you become more knowledgeable and confident investors.
Exactly. So to all our listeners out there, as you continue your investing journey,
Yeah.
remember what we talked about. Look for quality value resilience. Be patient, do your homework, and never stop learning.
Couldn't have said it better myself. The world of investing is vast, and it's always changing.
It is.
But with the right mindset and a dedication to, continuous learning, you can absolutely navigate it and reach your goals.
Beautifully said. And remember, folks, this is just the beginning. Keep learning, keep asking questions, and keep that fire for knowledge burning. Until next time, happy investing.